Let me know when we're live and I'll start presenting today's trade alert. And I'm just looking for your Telegram. Okay, we're live, guys. All right, I'll start off by reviewing the trade alert. Then we'll take a look at what's going on in the market, some charts, some news, and discuss our plans. And don't forget, tomorrow is our boot camp day. We're going to review how to take advantage of a very unfortunate circumstance in China. Okay, so today's trade is to allow the 330 SPY put to expire worthless. Now, if you are new to the program, you probably came in wanting to sell call options, which is usually our go-to strategy. However, in the current crazy market we're living in, we're seeing the SPY gap higher and higher through lots of volatility. And that's because there's a lot of uncertainty in the markets due to China having to shut down its entire country practically for the last several weeks. So we'll take a look at how that will impact markets. But right now we're living in an upside down world. Shutting down China equals stocks rocket to world highs because central banks are going to cut rates. So we'll go over how crazy this all is. Today we're just buying a cheap put for about 46 cents and expecting the SPY to continue to melt higher as people who were short the market last week are rushing to cover their position. If we scroll a little bit lower in your trade alert, you can see the accounting from the previous trade. This has got to be one of our top returns to date. The SPY traded from 333.36 to 337.10 for a appreciation in the underlying asset by 374. Your put option expires worthless. And trust me, one day you will be happy we own our puts. Just most days, that's not the case, at least yet. In our model portfolio, if you do subtract the loss in the put from the appreciation in the SPY, that's one hell of a return, and we picked up $3.28 a share or $328 per contract. In our model portfolio, that's 1,900 shares or a gain of $6,232 in the past 48 hours. And again, our goal will be to lock in those profits and expect some volatility in the coming weeks ahead. Just not quite yet. Okay, so if we do go down a little bit more, the next thing I have for you is our P&L. I'm going to zoom in on this so we can look at it. This is just if you're following the SPY program. Now, a lot of people on the webinar do follow our full program, and there's a lot of good reasons to own the TLT with the SPY, but I'm not going to focus on that today. So we'll just really focus in on S&P 500 predictions and how we're going to play that for folks just following the Monday, Wednesday, Friday trades. So keep in mind, if you are on a free trial or you just have our basic light program, Thursdays where you can really add a huge layer of protection and take advantage of other markets if you want to be part of our pro program. So far we hit a 2% return in February and a 1% return in January. And we've done this not just by being long the SPY, but we've done this while having downside protection at all times. So it's much more impressive to me, at least, in over a decade of doing this, to see someone who can deliver returns with absolute protection the whole time. We're not pretending to be a wild cowboy and just trying to hit big gains and close our eyes. Instead, we're doing a very smart strategy that extremely limits risk. Okay, so moving along, you can note that I have switched over to the Thinkorswim platform for your risk graph, or rather your risk table in this case. And I was able to actually get it to have the covered SPY. Some people know this as a married put. They call it a covered SPY. This shows you the complete order, the maximum profit, the maximum loss in a single trade. And so essentially our risk today is $434.50. We have purchased the February 14th 333 put. And I showed you how to place this with a market order. So this would actually cover purchasing the SPY and the long put at the same time. So let me pull up my little mouse thing just to go over this. Accounting wise, if you're following the trade right now, I want you to do two things. Number one, write down what you had to pay for your put option. One, and then two, write down the value of the SPY, because on Friday we're going to compare two things. Number one, how much money did we make or lose on the SPY? And then number two, how much did we make or lose on our put? So a very simple trade today. We'll go over what could go wrong, but again, expect to close this trade out Friday. Now I will be traveling to Arizona for a soccer tournament this weekend, and I'm actually expecting to see perhaps some volatility over the weekend, the risk of some bad news hitting the market, which I think could create a short-term dip on Monday. But then again, I'm still expecting the market to fly higher into next week. So Friday's trade, expect to have a put option, very similar setup as today's. However, we will set the expiration for Wednesday. So you guys will have Monday off next week. And again, my expectation is to see that put option doing its job, providing some protection through Monday. And then most likely we continue this absolute insane push higher in stocks. Now, are there any questions to start? I don't have my question box set up today, Dean. So if you do see any questions, if you could read them out loud for me.
Okay. Yep. Give me 1 second here. Let me get that screen set up, and we will. I'll read them over to you real quick. Okay.
Okay, great. And I'll throw up some charts while we're waiting here.
Okay. Cool. So let's see here. Okay. Okay, and let's see here. Just trying to get to. We had quite a few questions before we started up too. So give me just 1 second here. Okay, so Kathy C said, in addition to the cash to buy the SPY, how much extra do you need to put on protection? And Jay, what I told her, bud, is an extra $1,000 per 100 shares will be more than enough at any point, anything we do. So we answered that one. So sorry if I didn't need to read that out, but great question, Kathy. Okay, let's see here. And then Kathy also asked, I was following your TLT, EM, and GDX. I did not get the email with what you did yesterday. Can you email or share it to me? Yeah, Kathy, it's going to go out to tomorrow. So all the updates on those positions for the pro portfolio will go out tomorrow. Okay. So let's see here. Okay.
Yeah, Kathy, we just made a small. You should have had an update yesterday, which told you no changes to EEM, and that we're combining that with the TLT GDX trade on Thursdays. So if you do go look in your email, you should have that.
Okay, and just a couple other people were just talking about profits so far. And nice, Karen, nice, picked it up for 25 cents. Awesome. So picked up the insurance much cheaper than we did. So that was good. So you have a little bit more ROI on that trade. Okay. Okay, cool. Jason, we've worked through the questions at this point, and Ryan actually just posted to Ulster the link to get the recorded version. So as far as question goes, you are good at this point, bud.
Okay, great. Well, let me go through some charts, predictions. So yeah, this is just crazy that we have China shut down. We have a pandemic spreading throughout the world, and the market's reaction is to shoot higher. And so why is the market shooting higher? Well, the central banks have pretty much two strategies. They call them blunt tools, but they're powerful. And they really just have two main strategies. One is to cut interest rates. That is bullish for stocks. And they tend to do that when they think businesses are going to be disrupted. And so what's the effect of cutting interest rates? Well, number one, it makes the cost to borrow cheaper. So the idea is that companies and consumers will be more likely to borrow if the cost is less. And so this helps create spending and boost GDP. So if you're going to shut down part of China, and currently even Beijing, Shenzhen, the only towns that they're starting to get back, and I'm not going to call them towns, just these are cities the size of New York. Looks like they're trying to force people back to work for the really the bread and butter of China. So they have ambitions to jump into tech and all kinds of high tech industries to compete with the United States. And that's why the United States is freaking out. We don't want them approaching our military capacity or tech capacity. And they're trying to. But where we don't mind China is to sit there and assemble electronics for $3.50 an hour. So we are starting to see some signs that they're going to literally force people back to work to get that part of their economy back. But that's not going to get them to full steam. And I can just go pull up articles simply on cruise ships where they've diagnosed the coronavirus spreading rapidly, and it's not being accounted for in the Johns Hopkins data. So my anticipation is that this is far worse. Also, I was doing some research yesterday in the United States. 7,500 people passed away. Okay, that's one data point. Two, if we just look at the amount of deaths from the flu in January, it's over 5,000 people. It could be close to 10,000. Okay, so if that's the case, the United States doesn't care. We don't have any quarantines. We're not doing lockdowns. You don't see people in LAX wearing face masks. So why is China over supposedly 1,000 deaths in January? Tell me this, why have they locked down 2/3 of China? Why are they rushing to build massive hospitals? So clearly, we're not being told the truth to the extent of this coronavirus. And that's why I believe we're seeing stock market and the bond market get a huge bid as China is trying to cover this up as best as they can. And what comes next are most likely rate cuts and quantitative easing, potentially at the same time. So I think we're going to get a lot more news flow coming out on the coronavirus, potentially within the next 4 weeks, as they can only hide the real numbers for so long in terms of imports, exports, starting to see supply chains get caught up and things of that nature. So my expectation is we're going to see the SPY potentially hop up through next week. And then I think we will see some news flow. And that's when we'll try to lock in these profits and be able to make some money in the opposite direction on the SPY. So you can see we've busted right through that channel I was watching. And currently the call option market's really betting on that 340 as a top. So let me just pull up that so we can take a look at the option gamma. Here's where we have the option data table. This is a really handy website. It just takes all the different strikes into the future and tells you how much open interest we have sitting at each strike. And it was Monday when I saw this massive, massive pileup building at the 340 strike. We also saw the SPY and TLT going up at the same time, which is highly irregular and just shows you that there's just so much funny money being printed and pushed into the banking system. And the bottom line is it looks like China is simply buying up everything that's related to China internally as investor money flees out and purchasing up US products. And that's really the only time you get the SPY and the TLT to go up at the same time, is you have problems in emerging markets. Okay, so that's where we're looking at for a short-term top. Now, if I start to see the market recompile to a higher strike, I might be willing to bet that we can go a little bit higher than 340, but this is a huge move. And so I think by next week, we will start selling call options and really using that tight option collar to the point where we can even flip over to an inverted option. Can you see the option data table Dean and Ryan?
Yeah.
Okay, good. I was seeing something from Ryan saying he couldn't see it, but
Yeah.
okay, so
Does
that's where we
everyone know
see.
what option beta is too? And what spot gamma is? It's a little technical. But yeah, Jason, I was looking at this morning too. Look at the freaking capital difference between the call strike and the put strike. 10-1.
Yeah, so last week there was a ton of money in the put options, and now they're all having to cover. That's what one of the reasons I thought we'd get a melt up this week.
Yep, exactly. Dealers are forced.
So that's one data point we're keeping a close eye on. Let's look at a few other. Okay, also another item I really like to track is a huge impact on markets. And if we had seen the TLT pulling back on Monday, that would have told me that we're going to have a hard time selling our debt. How does that look, Ryan?
There
And
we go.
so,
Looks great, Jason. Very nice. So Kathy asked to explain the inverted option.
sure, the inverted option caller will be a trade that delivers a profit if the SPY goes lower. So our strategy is multi-directional. I rarely make down bets. And when we do, we go for big gains on those with low risk. So we had that set up last Friday. And we were sitting on a profit until the market started gapping higher right at the open on Monday. And to see the TLT and SPY go up at the same time tells you one thing: money is flying out of China at lightning speed, at light speed, and they're gobbling up U.S. products. And so this means the government can sell its debt, and that emerging markets are really, truly suffering at this point. Now, if you look at a chart of EEM, you wouldn't know that. But again, China printed in the wake of this epidemic, they printed $180 billion. So we'll see how long that lasts and how long investors will put up with them devaluing their currency to support their assets. So this should have been a really tough time for markets this week because of the part of the yield curve that we're auctioning off was the portion that the Fed's not picking up. So right now, the Federal Reserve is picking up almost 90% or more of our bills. But what they're not buying are our notes and our bonds. And so that was the big sell this week that could have potentially dried up all the liquidity in the US banking system. But when there's a crisis, especially abroad and not stateside, that makes it easy for the US government to sell its debt, and it's continuing to do so at record low interest rates. So this was a potential risk factor this week, but because of, again, the crisis overseas, it's making it easy for two things. One, for the US to sell its debt at super low interest rates, and then two, where's all that debt going to flow from the government? Well, it flows into the US economy, which boosts our GDP and makes corporations more and more profitable. So that's one risk we were focusing on this week. But by Monday, we could tell that that was indeed the picture. The TLT and SPY are going up together. Here's a look at the Johns Hopkins data, and it's just really stopped updating. The only one that seems somewhat accurate is the Hong Kong data, which has been going up significantly. Now, the Hong Kongers are well aware of the risks. They had to get through the SARS virus, and the big thing happening in Hong Kong related to the coronavirus is now if they spot an apartment or any building with any infection, they're now evacuating the entire building because it's starting to look as though people are actually getting they're getting infected simply by using the restroom because of the toilet spraying a little water into the air, and this virus being able to live in the sanitation system. So I really don't think we've seen the end of the coronavirus. Again, if we had between 5 to 10,000 deaths in the US with a 350 million population in January from the flu alone, and China wants to sit here and say they're willing to shut down 2/3 of their entire country because of 1,000 deaths, it just doesn't add up. So I'm still following this closely, but we have to play the news flow related to the S&P 500. And so I think that's why, again, we're seeing such a crazy melt up, as China really is in some trouble here. So we'll keep a close eye on that. Next thing I like to check daily is our yield curve. This is not always the case, but in the past year at least, this 2-year and 3-year Treasury has been very accurate at predicting what the Fed will do before it does it. And it is indicating rate cuts. So that is both positive for the TLT. If they do start to go into a period of rate cuts, we can expect the front end of the yield curve right here. And you can see we're inverted again, inverted yield curve. This likely needs to drop down to 1.25 in the very near future to straighten the yield curve. And this is important for banks because they are borrowing at one rate and lending at another, and this messes up their business model. So my expectation is the Fed will start to slowly cut rates into 2020 to try to offset the slowdown from China. And again, okay, Mark Stoley thinks that it's not the toilets spraying water that is infecting, but perhaps a leaking plumbing. I saw that too, so definitely keeping a close eye on that as well, Mark. And good point. So my expectation is that these rates will be dropped, even though they told us that they're going to stay flat. This is a very quickly developing problem. And regardless, they do seem to copycat whatever China does. And the expectation is that China will cut by 100 basis points. So perhaps we see the US cut by anywhere from 50 to 100 basis points over the course of a year. I don't expect they will do this in the next meeting. So what's the impact? Well, that's going to make the SPY and TLT both go dramatically higher. And that's great for now, but you got to ask yourself, what do we do when our federal fund rates get close to zero? And that can become a whole new problem to worry about. Okay, next thing I like to look at is the repo market. This shows us if there's enough liquidity in the banking system, which is important because a lot of this run up in the stock market and bond market is due to hedge funds using massive amounts of leverage. And if the banks run out of cash, they can't create this leverage. That's been continually pushing the market higher and higher. And it's a very momentum-based market. It's one where if the SPY doesn't keep traveling higher, if it just goes flat, it starts to turn all these trading systems into a sell signal. And then if it starts to sell off, well, we get the exact opposite. We get every sell signal turning into a short signal. So we have been seeing the banking system starting to get oversubscribed in the repo markets in the last several weeks. Today, it's been pretty clean. Here's the last one where we had a oversubscription. So I'll zoom in on that. And again, if the US banking system runs out of cash, it can't lend money to broker dealers who in turn are loaning it to the hedge funds and retail investors. So if we start to see this happen daily, that's a big warning sign for markets. And we'll want to really tighten up our option callers on both markets, not just one or the other. But most likely the market to really be scared about is will likely not crash in this current environment because China has half of its country shut down. So I think there's a far greater risk in the SPY versus the TLT. So if we keep scrolling, we can see there's been a few times where we've been oversubscribed, but not too much. Here's the next example where we were oversubscribed, and this was on February 6th. So that's very important to keep a close eye on, something we do for you daily here. Okay, tomorrow we'll be looking at the H41 release. So the Fed continues to get more and more clever about how they can distort markets or keep the business cycle going, or whatever you want to call it. This is updated at 2:30 and that's Mountain Standard Time, 4:30 Eastern, right when the market closes. Give it a half an hour, they post this. And this is where they tell us what they're doing to their balance sheet. And so again, if there's a crisis abroad, typically the US government can easily sell its debt and not have to do it to its own banking system, who legally has to pick up the tab if no one else will. So my expectation is the Fed's balance sheet will not increase week over week, and they will continue the same path we've seen, which is to pretty much gobble up all of the short-term debt, which rolls over quickly and which they call not QE, and then to continue trying to sell the notes and the bonds to foreigners. And I think foreigners are very happy to pick up US treasuries. Not only is the dollar strengthening, which makes the value of the interest of the bond more attractive, clearly they can see the risks of China being shut down for a prolonged period of time, which makes their decision-making quite easy. US products are safe, and emerging market products are highly risky at this point in time. So I don't think we'll have any big news there. I think we'll continue to see the government is selling its mortgage-backed securities in massive quantities and picking up a huge amount of our short-term debt. Okay, next interesting chart to look at is our copper gold ratio. They call it Dr. Copper. And if copper is headed down, that typically means your TLT is headed up. And again, we have this very rare period of time where the TLT and SPY are going up in general together. And this only happens when you have big problems in emerging markets. So this is also indicating rates are heading lower. Very useful comparison is the gold copper ratio. And I just wanted to pull up a few charts for people looking for some long-term predictions. We haven't looked at this in a while. There's really two really critical charts you want to study that most people don't have a clue about. Let me pull these next to each other. Okay, so the first chart that really nobody knows about is this one right here. And if you listen to people like Ray Dalio, their concern is that we're living in this period of time right here, like the 50s and 60s, directly out of World War II. Government is spending like crazy, trying to take care of everybody. Politicians do this to win the vote. And what happened? We ended up in a period where Paul Volcker was forced to raise the cost of money all the way up to 20%. And people don't realize they make all these models, all these predictions, all these ideas about how to invest based on starting in 1980. And they like to just leave out this period of time. And so I'll show you in a minute what happens to the stock and bond market. What happens to your half stock, half bond strategy if you go through a period of time like this? Well, you're going to lose just about everything. And so to believe that we're in a world that will always go in this direction with yields or with the cost of money is foolish. And you can see, once again, we're bouncing this off the bottom. And that will eventually create a period of inflation. And that's when they end up hiking rates. So let's go now to the Dow over these periods of time. Okay, so this is 1965. This is 1990. If you had bought the stock market right at this massive 1964, 1965 time period and believe that, hey, things will never be bad. They will always go up. I don't care if there's a stock crash because it'll just rebound like it has for the last several decades. Well, you had to wait for approximately 25 years to get back to even. And so if you don't realize that we're approaching a period of time where if we keep rates this low for too long of a time period, we're going to get runaway inflation. And there's only one strategy to do that. It's to raise interest rates. What happens when you raise interest rates? You get all the malinvestment. You get all these companies who are borrowing and creating big, massive losses year over year, only to borrow more and more. And eventually, you get so much inflation that you get social unrest, and you end up having to hike the cost of money, which destroys GDP. It destroys the bond market. And this is what I believe we will see in the next several decades is a period of time like this. So we got to enjoy it while we can, these low interest rates. But don't build a retirement strategy that relies on analysis that's based on just cutting rates, because we can't cut rates below zero. And then just always realize if you don't have a strategy that can make money to the downside in stocks and bonds, you may not have the best system. And so certainly if you've been following our program, you can tell that. Okay, let me go ahead and zoom back out. Any new questions popping up in there?
Okay, Jason, let me take a look. Nope. Karen said that's because you guys are youngsters like you guys, and she said the canceled history. You guys are an anomaly. Stagflation.
Yeah, most people don't want to look at pre-1980. That's for sure. Okay, so let's look at some more charts. So this is a 5-year chart of the SPY. You can see it. We've been bouncing in these channels right here. We're poking our head through it. My expectation is it won't last, but my goal is to get us to 340 and then start trying to lock in some of these profits for the potential of a little pullback. I'm not expecting anything nasty. Now, here's one of my favorite indicators on the SPY. And this is LQD. This is our investment grade bond fund. This is what's fueling, there's really two things fueling the stock market. One is the government's debt is so large that we can't pay for it with tax receipts. So they are having to sell their debt into the financial system. And for a while there, right when we signed that deal with China, nobody wanted to buy the debt. And that's when we went into quantitative easing, and we were seeing the balance sheet grow, or the amount of dollars in the system grow dramatically ever since September of last year. Now that all stopped in January as we've had crisis after crisis make it easy for the government to sell its debt. So that's one way to bet up on stocks, is if you do see the Fed's balance sheet increasing, that means the money supply is growing, but the amount of shares are staying the same. And if we have a big deficit, you can bet there'll be a great GDP. So that's pretty simple. But now we've had crises begin in January. So why are stocks still going up? Well, here is the next big buyer is your corporate buyback scheme. So think about it. If we're making $100 million a year and we have 1,000 shares outstanding, and we don't really think our company is going to grow that much year over year, how could we still make the stock rocket higher for the rest of the year? Well, it's pretty simple. We go sell debt. Okay, and Microsoft actually was selling some negative yielding debt last year in Europe. Sell that debt for a super low interest rate, and let's just go buy back our company's stock. In fact, that's what Apple's done. They've reduced the outstanding shares dramatically. In fact, they're on track to have no outstanding shares within 5 years if they keep their stock buybacks at the current pace. So I think they've bought back something like 20% of all outstanding shares in the last couple of years. So if this is at a record high, that means not only are the interest rates at record lows, the demand to buy corporate debt is also at an all-time high. And in fact, so far in 2020, corporate buybacks are 22% ahead of where they were last year. So it's going to be hard to get a significant sell-off in the US stock market for a prolonged period of time until this ETF is headed south at a rapid pace. And so far, it is not. It is near all-time high. It is at all-time highs. So we can count on these corporations purchasing back its own stocks. Now, this does represent really the top of the top in the S&P 500. The next one I like to look at is the junk bond market. Let me jump over to this ETF. Now, this is more correlated to your Russell 2000 companies, which can be a drag on the S&P 500. And we can see it's not at all-time highs, but it is in a decent range. So your Russell 2000 can still gain access to capital. I think it was averaging 5% yield, so it's still super attractive. And this allows the Russell 2000 to have some breathing room. So perhaps this will be the first ETF to tank before LQD, almost certainly. And perhaps the single most important ETF to watch if you want to be taking on a lot of risk in the S&P 500. So far, we look great. Not as good as the 2014 rates. And if you remember what happened here, this is the first time China almost crashed the global markets. And again, they did this without any US intervention. In fact, at that time, we were best buddies. We had Obama and Joe Biden and John Kerry giving China whatever the hell they wanted. And they still managed to almost crash global markets. So now we have an administration that is trying to punish China at every step. And so, again, I believe this will be perhaps the best leading indicator for downside ahead with U.S. stock market. Okay, next key indicator for predicting the SPY is DXY. Bottom line here is if the DXY is traveling higher, this means that emerging markets are suffering. It means their currencies are losing value relative to the dollar. And this is very bad for any country who has debt denominated in dollars. And so our expectation was a weak dollar with a strong emerging markets and for yields on the bond market to be rising. And pretty quickly in 2020, we saw the SPY and emerging markets break paths. And I sat there scratching my head, wondering what on earth was wrong. We essentially signed a deal with China where they would reroute $200 billion of imports, which they could pull off. It might piss off some of their
Hey,
current trading partners.
hey, Jason, real quick, bud. Just want to let you know I have to jump to my doctor's appointment, but just wanted to let you know before you're asking about chats and stuff. So,
Okay, great. I got Ryan posting questions on my Telegram screen here, so I'll
okay,
keep a look for any questions there.
awesome. And thanks, guys, for joining us here today. And call me and text me with any questions. Okay. Thanks, Mike. Appreciate it, bud.
Okay, catch you a little later, Dean. Thanks.
My pleasure, guys. Enjoy the webinar.
Okay, great. We'll see you in a bit. Okay, so if the dollar index is going higher, that means emerging markets are having trouble. And again, that makes us want to be short emerging markets and then long the TLT and SPY at the same time, which is really a nice setup for us because we know those two assets already protect one another, but to be able to have them both go up at the same time is very irregular, and again, only possible if there's trouble in the rest of the world. So that was the case. Now in 2020, in early January, we saw the SPY pushing to new highs, and all of a sudden the rally in emerging markets sputtered out. And so we couldn't figure out why. Now, the supposed deal was China would reroute 200 billion in purchases, which was way over what they had advertised in October. So it really made you wonder, why did they suddenly go from picking up some extra agricultural purchases to this gigantic $200 billion commitment? And if you really read through the trade agreement, the key analysis that I pulled out of it that wasn't really spoken much of in the US was that our banks were going to come in and buy up the bad debt in China. So what exactly does that mean? Well, it looks like the US banking system, which is a global corporation, really wants to finance China's Belt and Road Initiative so that it can collect the interest on it for decades to come. And the amount of debt they need to sell to orchestrate this massive project is to the tune of $1 trillion a year. So China loved that trade deal because all they have to do is reroute some orders they were already going to purchase. Sure, they might upset some of their key trading partners, but not the end of the world if they can get this huge financing to go continue what they're doing best, which is to build infrastructure projects. And so to see that SPY emerging market break paths, and let's go look at that. You can see just this crash right here. It really didn't make sense. They should have been highly correlated. And when those were breaking paths, we were seeing the dollar go up. The problems in the Middle East really didn't affect China. So it was really making me scratch my head and wonder what on earth was going wrong. And then sure enough, we found out, hey, there's an epidemic in China and they're rushing to build massive hospitals. They're doing quarantines and shutting down China for a prolonged period of time. And so the news flow came after the stock movement in this case. Now, China's response has been to aggressively print money. They've outlawed selling key companies. And so they're trying their best to manipulate and protect their stock market at this time. So I believe this will come at a cost. And so we'll see where exactly their weak point will be. Quite likely the currency is the most at risk right now. So far, we haven't caught a big move on that. Let me go to Tuesday where we look at, here's their currency. So we can look at this chart, and again, this is a boot camp trade that we will be reviewing on Thursday. I'm not quite ready to pull the trigger yet, because they're trying to roll out this whole narrative that the worst is behind us with the coronavirus, that the confirmed case count has been going down for 8 days straight, and that everything will be back to normal. They'll meet all their targets, and part of the trade deal for them to get this financing plan from the US banking system is to keep this exchange rate around 7. They really don't want it to go above 7, as that gives them a lot of advantages, especially when they control their currency in the fashion that they are. So we have the economic pressure in China mounting. What I would like to see again to have the confidence to place this trade is to also see the political aggravation from the US. And so I am skeptical to place this trade until we get through the election, although we are on high alert and we'll review that trade in detail for our boot camp members tomorrow. And again, there's 2 trades. One is the Hong Kong dollar and the other is the Chinese yuan. And for that, we use the Hong Kong exchange through Interactive Brokers in the futures market. It's the only way to place that trade. A little more advanced. You really got to understand how the futures market works if you're going to put some risk in that. And so we will review that just to be prepared. Now, if China really can't open up shop for a prolonged period of time, and this whole narrative that they're back to business by February 20th is false, I'll be inclined to place bets betting down on China in all aspects. So stock market certainly is going to be hit if their business remains shut for a prolonged period of time. If they're going to print $250 billion in a few weeks and continue to do that to try to protect their stock market, well, you're going to see their currency devalue. And again, this is a trade that we can be placing for the better part of the next decade, not just a quick hit. And then finally, it's almost with certainty that they will be doing rate cuts, so we can play the bond market with that as well. So we'll be looking at how to do all 3 of those tomorrow in our boot camp. So stay tuned for that. Next chart I'd like to pull up. So we looked at Dr. Copper in terms of predicting yields. And again, predicting yields are very important for predicting the stock market. We're going to compare the German yield to the US yield as another predictor of markets. And so in the green line below, we can see the German yield is a very good leading indicator. And the lower the German 30-year goes, the lower our US yield can go. Because really, all the government's really worried about is having an attractive enough yield to pull off selling about $1 trillion of deficit per year. And that's going up. But again, the German yield and Dr. Copper are all pointing to lower interest rates. And so this does make us want to be long the SPY and TLT at the same time, and signals, again, there is significant trouble in emerging markets. Germany is really tied to the hip to China. And so when we can't trust China's data, we have to rely on what's happening in Germany. All right, guys. That's the bulk of our presentation for today. Let me see if we have any questions. And again, Friday, expected trade that will cover us through Wednesday. I won't be doing a webinar this Monday. And most likely we'll do one more of these long puts with no covered call. And this way we don't miss out on this just extreme melt up in the markets, which really makes no sense. We're really in this upside down world where bad information means, hey, central banks are going to push the market higher. So that's really the move that we're seeing right now. All right, any last questions? My expectation is we are going to get some volatility in the SPY. On the TLT, despite this massive move on the SPY. So this all really coincides with our plan to be long SPY TLT. And so again, right now we have downside protection on the SPY. At some point, I do expect bad news flow related to China. We're going to catch the sell-off by being long the put, so that'll reduce that. And then our TLT, for those following the full program, can really deliver a big spike higher. That's my expectation. At that point, we'll put a put under the TLT and probably start selling calls as well. And then look for a rebound in the SPY, because again, I don't think the SPY will have a significant sell-off until we see HYG really nosedive. And that just may not happen until we do cut rates all the way to zero. So we've got some ammunition. The next big thing we want to focus on, I believe in 7 to 10 days, we'll get the Fed minutes where we can get some insights as to what their plans are. But I would suspect that they're getting concerned with a slowdown in China and that they will be cutting rates this year. All right, well, that's a wrap. We'll see a lot of you guys tomorrow. And tomorrow's two items. We'll trade TLT, GDX, emerging markets with one single trade alert and webinar. We'll try to get that done in an hour time frame so everybody can have an hour break for lunch. And then we're going to hop back on and we're going to focus on reviewing how to use the futures market to short the Chinese currency. We're going to look at the potential to short their bond market, expecting rate cuts. So similar to being long the TLT. And then we're also going to look at the opportunity in the Forex market to short the Hong Kong dollar. So again, I'm not ready to pull the trigger on that yet, unless we see Hong Kong and China remain shut down beyond February. So if we see that they just cannot open up shop and get back to normal operations by the end of February and we get into March, that's when I would really be concerned that this is far worse and really out of the hands of central banks to really save the day here. Okay, so I really appreciate everybody. Thank you so much. If you're just on a free trial, we'll see you on Friday. And again, expect the next SPY trade to cover us from Friday to next Wednesday, with Monday being off. And tomorrow we will roll over our emerging market trade, same setup, expect the exact same play, and then to remain long on our GDX TLT position. But we'll talk about when we would get more defensive on those two positions. All right, Ryan, if you want to go ahead and wrap it up, and in the presentation, that's a wrap.